All right, guys, thanks so much. Yeah, Ron Shevlin is the Director of Research at Cornerstone Advisors, a senior contributor at Forbes, and is also ranked among the highest fintech advisors among social media. It's great to have Ron with us today to discuss this space, the DeFi space, and fintech in general. It's been quite a year overall for fintech and the DeFi space. Ron, tell us a little bit about what we need to be paying attention to as far as some of the more significant trends that have come out of this year, and tell us maybe what you're excited about, what you've been tracking closely over the past month or two.
Absolutely. Thanks a lot for having me on, Brennan. I appreciate being with you today and sharing some thoughts with everybody. From a fintech trend perspective, I'd sum it all up in one word: infrastructure. If you look past the past few years, the focus had really been a lot on the direct-to-consumer players like Robinhood and so forth, who were going directly after consumers. The trend today is about infrastructure, a little less sexy, but this is where the money's at and where the trends are. And when I talk about infrastructure, what I mean are companies that are capitalizing on a trend that's called embedded finance. What's happening is that a lot of non-financial companies are looking to provide financial-related services to their customers as a way of driving loyalty. So think about Uber providing checking accounts and debit cards and loans to its drivers. Think about Gerber, who wants to provide savings accounts and investment plans for new parents who buy their baby food. And the range of companies that are doing this is all over the map, and it's a huge opportunity. And some of the companies that are really taking advantage of this are some of the early fintech providers who made a name for themselves in the lending space, and who are now really capitalizing on this embedded finance trend, in particular SoFi, who acquired a company called Galileo Technologies last year to get into the embedded payment space, and Lending Club, who had gone through some tough times in the past few years, but has really rebounded recently. And a lot of that has been was the result of acquiring Radius Bank here in the Boston area where I live, who's been a strong player in this embedded finance and banking as a service trend. So this is clearly a trend that many of the existing fintechs are jumping on, but there's a whole new set of players, many of whom aren't even public yet, but who are raising money at some good rates, like companies like Move and Synctera and Bond, Railsbank. These are all companies that are capitalizing on this trend, and I expect it to be a very strong trend over the next couple of years.
And as far as the remote type trend, we'll continue along that road or pathway at this point, Ron. Let's talk a little bit about touchless payment. Let's talk a little bit about the COVID-19 pandemic, because there's been some significant changes and advances come out of the fintech space in relation to the COVID-19 pandemic. Tell us a few of those.
Yeah, I'll make a point that I don't think anything new came out of the pandemic. What the pandemic did was accelerate a lot of the trends that had already been taking place. So, for example, things like mobile payments. Touchless or contactless payments through the mobile apps from Google Pay and Apple Pay exploded last year. And this was important for a lot of banks in particular, because many consumers don't actually link their primary bank or primary credit cards to Apple Pay or Google Pay. So this caused a little bit of a shift in payments last year. But beyond that, the buy now, pay later trend has really taken hold in the US. It's been a global trend. And I think a lot of people don't realize that it did not take off very rapidly here in the US. I estimated that last year only about $24 billion of purchases were made with buy now, pay later programs. And that's out of $5 trillion of retail spend. I expect that number to quadruple this year to about $100 billion because of strong adoption among Gen Zers as well as millennials. That's not very popular among older consumers. But as the trends continue to shift towards digital commerce, e-commerce, that buy now, pay later trend continues to increase. And then another important trend is, of course, crypto. I mean, obviously, crypto gets a lot of attention as an investment vehicle. But what I think a lot of people don't realize, Brennan, is that half of people who own crypto today either have used it as a payment mechanism or expect to use it as a payment mechanism. Coinbase, which is one of the popular crypto exchanges, has launched a debit card that enables its customers to make retail purchases. And I expect that it's going to really accelerate with PayPal, who's enabling its members to make crypto payments. And the other one to watch is Square and Venmo. Venmo's also now enabling its cardholders, its customers, not really a cardholder there, enables its customers to purchase to cryptocurrencies. And Square has really been the early leader in this and really is tearing up the market.
Challenger banks and neobanks have been another, hot topic over the past couple of months, specifically, and going back into the latter part of last year as well. And we speak of, Boro, Chime, another one. Talk us through what investors need to be aware of when it comes to challenger banks in general. Maybe if some people have yet to hear that term or really understand what that is.
Yeah, so Chime is a great example of a challenger bank or a neobank, and I think those terms are pretty much interchangeable. And what they really are is just a digital bank. It's actually, you can't even call them a bank. Chime has been sued or challenged by the California regulators that they can't use the term banking, but it's really a front end to some bank in the back where they're really just a front end. Chime in particular has been incredibly successful. There are about 20 million customers now, and just raised $750 million at a $25 billion valuation. The challenge for the challenger banks are their business model. They're still predominantly making money just from interchange off of transactions. And look, that could be wiped out with one regulatory move or really struck down in a regulatory move, as it was about 10, 13 years ago when the Durbin Amendment hit. So there's a bit of a challenge for some of these existing players. But the longer-term trend is very interesting here in that many of the challenger banks who are emerging are taking a very focused approach to the market, finding niches of the market that they believe are underserved. These are not demographic segments as much as they are affinity groups. So I'm thinking, for example, of a challenger bank called Panacea Financial that focuses on the financial needs of young physicians, not just all physicians, but young physicians who are just getting out of school, need loans to buy into the practices, don't have credit histories and credit scores. Thinking of challenger banks like there's a bunch of others I can't think of at the moment. But this is kind of the long-term trend of this sort of splintering of the banking market, focusing on very narrow niches. Many of these companies aren't public yet, but as they continue to grow from a customer perspective, I would expect many of them to go public in the next couple of years.
As we said, a senior contributor at Forbes. Guys, go to Forbes.com/sites/Ron Shevlin. We'll get that site and put it out to everyone. Ron, we appreciate your time today. Great information. Thanks for doing this.
Thanks, Brendan.
Have a great day. There we go, guys. It's an interesting sector. It's an interesting topic that continues to evolve and change as we go here.